A recession may be around the corner, and you have to know exactly how to trade options during a bear market, because the strategy that we've been using, the wheel strategy, is not the same during a bear market. So I'm gonna reveal exactly what I did in the last bear market in 2022 and exactly how to trade a bear market profitably so you don't lose your whole portfolio. Now let's go ahead and get into it. Hey, welcome back to Options with Ryan. Now, the current portfolio is sitting at around 659K, and I'm going to be documenting this live, turning this into 10 million in the next 7 to 10 years. So if you aren't subscribed, make sure to hit the subscribe button down below. And if you get value out of this video at any point, please hit the thumbs up button. I really appreciate it because that helps get this out to more people. Now, before we jump into it, if you want my options picks straight to your inbox, go ahead and hit the link in the description. That's going to take you to Options Trading University, which is my free newsletter. And I'm going to be emailing you Monday, Wednesday, and Friday. And if you want to speak to me personally and see my personal life, go ahead and follow me at It's Ryan Hildreth and send me a DM. I love to answer all questions, comments, and messages. So go ahead and do that. Now, remember, this is not financial advice. This is just me sharing my experience with options and how I've built wealth trading options. So let's go ahead and jump into it. The wheel strategy during bear markets. So if you don't know what the wheel strategy is, I have a full tutorial in the description as well. But for most of you, you probably understand what the wheel strategy is. Let me just run through it real quick. The wheel strategy consists of selling cash secured puts on your favorite stocks, such as Nvidia, Tesla, maybe it's the indexes like SPY or QQQ. Right? You sell puts, you collect monthly premium, anywhere from 2 to 5% per month on your money, right? And then eventually the stock will come down and breach your put price. So that means you will get assigned 100 shares of that stock. Once you get assigned 100 shares, you immediately start selling covered calls against your shares to generate premium income, right? Monthly income, anywhere from on the call side, anywhere from like 1.5% to 3.5%, right? And then eventually your calls will be in the money because the stock just runs up past your calls. Your 100 shares get called away at a profit, plus you collect the call premium. So that's a double profit on the call side. I actually make more money selling covered calls against my stock than I do just selling puts, okay? So shares get called away, and you run this whole thing over again. You sell more cash secured puts. Now, how do we do this in a bear market? So let's go ahead and look at some of the worst bear markets that we've ever had. Maybe you've been through a few, if depending on your age. I've been through a couple, right? But I've only been through one that was pretty significant and the duration was pretty long. And I actually had money in the markets. Back in 2008, I was too young. I didn't have a brokerage account. I didn't even really know what stocks were at the time. So let's go ahead and kind of analyze why each bear market can be pretty easily predicted, okay? And maybe you didn't know this, so I'm gonna show you exactly how I look at it and how I was able to make it through 2022, unscathed and actually very, very profitable. And I'm gonna show you exact strategies that you can implement with back testing to prove to you with data that it works, okay? There's a back testing tool that I'm going to utilize. Now, back in 2022 to we didn't fully recover. If you bought in December of 2021, the S&P 500, which is what we're looking at, and you basically, your portfolio was unchanged, like you didn't make any money all the way till 2024, okay? January of 2024 was when we finally started breaching all-time highs. So your portfolio was just going sideways, down, right? Then maybe up a little bit. But your $100, maybe you bought it for $100. Let's just say you had $100 in the market. That 100 didn't change until 2 years later. So that was a pretty long bear market, but there's been longer, okay? So this one, the depth of the bear market wasn't that bad. I mean, 27% seems pretty bad. I believe on QQQ, we were down like 33%, but there was much worse bear markets, okay? But these could have easily been predicted. And this one, because of information being so readily available. That's why I believe it didn't go down as far and it didn't last as long, okay? Because everyone has a brokerage account and everyone has access to immediate news and immediate information. So that was a pretty decent bear market that we went through, and still a lot of people lost money. A lot of people lost money. Average investors sold at the bottom. People didn't know how to trade it, and they thought the market was never going to come back. Okay, this happens every bear market. Now, we had a crash in 2020 where I lost a lot of money, a significant portfolio, 6 figures. So that's why I have, confidence and actual proof that, I've made it through bear markets. And 2020 was a big blow for me and my wife, and it was a very, very hard time. But that's what made this strategy work, because I had to figure out a strategy that would actually make it through crashes, which rebound very fast, and bear markets. Now, this crash right here, the COVID crash, that only lasted 35 days. That recovered fully in 35 days. So if you were selling cash secured puts and getting assigned the shares down here at the bottom, you basically doubled your money in 35 days. So that's why you don't sell during at the bottom of a crash or a bear market. There's a better time to sell, which is at the top, and I'll show you exactly how to figure those points out. Now, this was 2008. We had a 57% drawdown. That was a pretty big one, and it didn't recover to all-time highs. Like, there was all-time highs in 2007, didn't recover until 5 years later in 2013, okay? The next one, 50% drawdown on the S&P 500. This was the dot-com bubble. We had a huge run up, and this didn't recover for, the highs were in 2000, and this didn't recover until 2007, okay? So that one lasted a good 7 years before you actually made your money back. So what makes all of these bear markets the same? There's only one thing, and it's very interesting that this isn't talked about very much, and a lot of people don't understand this, but you have to understand the flow of money. That money went somewhere else. It didn't just disappear out of thin air, right? That money went somewhere else. There's always a loser on the other side of the trade. So there was a lot of winners that sold at the top and put their money somewhere else. Now, basically what we have to understand is the Federal Reserve. The Federal Reserve controls the money supply. The more dollars that are printed or borrowed from the Fed, the more dollars chase assets that provide a return. So when people are scared of a bear market, but for just no reason other than, oh, well, the recession, the unemployment numbers look bad, or this look bad, or that look bad. All of that really doesn't matter. What matters is what the Fed does in reaction to that data, okay? Because they control the money flow. Now, institutions, banks, and people chase assets because the US dollar is inflationary, meaning we just keep printing it. The Fed keeps printing it. And the more they print, the less valuable the dollar becomes. So if your money is just sitting there in a bank account getting no yield, it's actually losing value because of inflation, right? This diminishes the buying power of the dollar. For example, a good example, house prices in 1950 were $7,500. You could buy a house in America for $7,500 in 1950. The average home prices today are around $420,000. So you can see that when money is printed, it chases assets or things that are scarce, right? They can't just keep building more houses along the coast of California, right? There's just not enough space. So those houses go up a lot in value. They can't keep building houses in, the good, safe areas. Those houses go up in value because there's just no more land to build houses, right? Just understand that money chases assets because it is inflationary. The Fed is a somewhat private entity that prints US dollars and has a board of governors that reports to Congress, all right? So when interest rates increase, the market will eventually fall because the market doesn't like interest rates being high because the cost of borrowing money goes up, right? So banks borrow less money, the government borrows less money, consumers borrow less money, right? And then less money is actually going towards assets because frankly, you could get better returns in risk-free assets, which we'll talk about next, okay, which is where does the money go? Okay, Ryan, the Fed raises interest rates. The market doesn't like that. Where does the money go? As the Federal Reserve increases interest rates, investors, banks, and institutions seek alternative risk-free assets, such as debt instruments that pay a coupon or a dividend, whether it's monthly, quarterly, yearly, right? So bonds, treasury bills, corporate bonds, institutional bonds. When the Fed increases interest rates, there's usually some economic falter that causes them to do so. So like the Fed doesn't just increase interest rates for no reason. They increase it because something is wrong with the economy, such as inflation in 2022, right? So that puts the markets into fear. Now, let's actually go back to the first bear market, okay? This one. This one was in 2022. All right, we're gonna go to this website that, it's a Forbes website that shows you the Fed funds rate history. So the Fed started hiking rates in 2022 of June 2022. Okay, that's when they decided, okay, inflation's getting bad. The cost of goods is going up. I remember gas in Texas when we lived there went from $1.96 to almost $3.50, $4, which was absolutely insane to see in just a short amount of time. I literally saw it like over a couple weeks. Right? So inflation was getting bad. They decided, let's raise interest rates back in 2022. So let's go back to the chart right here. This is when they announced it, right? June 2022, we had a nice pullback. That was the first tell. This was the time to start saying, hey, maybe I should start trimming some of my portfolio and leaving some cash on the side. Now, there was an even better place to do that, which was in December of 2022. Okay, this was when the Fed funds rate was about 4.25%, which is pretty average. That's kind of like the staple Fed funds rate, somewhere between 3 and 4.25. Okay, on this meeting, Jerome Powell, maybe it was Mnuchin, Jerome Powell, at the time said, we're going to continue hiking rates because inflation is getting bad. December 14th, okay? Look what happened. December, January, that's when the bear market started. So you could have got out right here. You could have got out, had your cash sitting there ready to go, right? Because you could predict these things because of the Fed. The Fed is controlling the money supply. They're basically saying, hey, we're going to basically not increase the money printing. We're going to decrease and soak up that money supply and get money out of the markets, okay? The same thing happened in 2008. You could have predicted that. If we go back here, 2008 or mid 2007, the market started crashing. If we go to the Fed funds rate, right? Let's go back to the Fed funds rate. Fed rate cuts in 2007, they started cutting rates because the market was crashing. But we have to look back at 2005 to 2006, the housing market boom. The rates, right? They started increasing rates in 2005 all the way to mid 2006, where they brought it up to 5.25. That's not too far of where we are now, right? So because the housing prices, I remember my parents bought a house in like 2003 or 2004, and the house literally doubled in price, okay? This was not sustainable. The Fed had to start hiking rates because the housing market was getting ridiculous. It was inflationary, and it's just not sustainable. People that made zero income or worked at McDonald's were owning 3 houses because, the banks were giving them mortgages. It was crazy. So the Fed had to hike rates. 2006, it was the highest we could have predicted. Okay, back here, we would have got out a little early, right? We had still a year of upwards action, but we could have just been maybe 50% in, right? And the reason why it didn't happen as fast back in the day is because people didn't have brokerage accounts. People didn't have Robinhood accounts, TD Ameritrade, Charles Schwab, Tasty Trade, right? There was not a community online trading options, right? People didn't have fast access. They had to call their broker, hey, can you sell my stock? So it took longer for the information to actually hit the markets. Nowadays, things are immediate. Right when the Fed announced in December, hey, we're going to continue hiking rates, boom, 2022, we saw a bear market, right? Literally a month later. So this was predictable. Dot-com bubble, very, very predictable. This one, obviously, again, the information wasn't readily available, but the Fed started hiking rates in 1999. They started hiking them all the way in 2000 to 6.5%, right? So that's the cost of borrowing. Like the government, if they want to borrow from the Fed, 6.5%. The banks want to borrow from the Fed, 6.5%. That was easily right here, right? 1999 to 2000, they started hiking rates. And then boom, a year later, huge bear market. All right. So now we understand what happens when a bear, like what causes a bear market, right? We understand that now. So let's understand where the money goes. Like I said, treasury bonds, okay? Treasury bonds, actually the yields go up when Federal Reserve hikes interest rates. So look at the Fed fund rate, right? Every time they hike it, they hike rates. Look what happens to the treasury bond yields. This is basically bonds are issued by the US government, right, as debt. And what they do is they say, hey, lend me your money and I'll pay you a coupon, right, every month for lending me money. And what happens is the yield on the 10-year treasury went up to 8%, right? You get 8% on your money risk-free because you're lending it to the US government. It's called risk-free because as long as you believe in America, that America is not going away anytime soon, then you could just leave your money in T-bills and get your free money, right? Risk-free. So back here in 2022, the Fed funds rate was nearly at zero, went all the way up to almost 6%. And look at the treasury, the 10-year treasury bill. Boom, you can get basically 5 to 5.5% at the peak on your money risk-free, right? So why would you invest in the stock market when you could just get risk-free money, let the economy get better, right? And then when things get better, then you could pull your money out of the T-bills and the treasury bonds and start investing in the stock market again, right? So like the 3-month T-bill was paying out almost 6% risk-free. Okay, so that's crazy, like risk-free money. So that's where the money went. Now the money is slowly coming back into the stock market, right? So let's create a strategy with great profit scenarios with backtesting. All right, so when the market, the Fed announces, hey, we're hiking rates, and don't worry, I'm gonna announce on my YouTube channel when the Fed hikes rates, so you will know when I'm shoring up cash, okay? But first I'm gonna go over 3 specific strategies. We're gonna do some backtesting, and then I'm going to go over my strategy. What did I do in 2022, okay? So you must flip bearish with your income generating strategy once the Fed announces that they will be doing interest rate hikes, okay? You cannot trade a bear market the same as trading a bull market because the trend is downwards, not upwards. So the trend is your friend. So now you have to start taking more bearish strategies. So we have bear call spreads, okay? 30 days till expiration, 30 delta. Let's go ahead and go into that. So this is my backtesting tool here on Tasty Trade, which is pretty cool. We're gonna be trading SPY, which is the S&P 500. We're gonna go to inflation-induced bear market 2022, and let's select the strategy. The strategy is gonna be a bear call spread, which is a credit call spread, but bearish, right? Is where you sell the 30 delta call and you buy the 15 delta call, okay? It's a spread. Now we're gonna change the days to expiration to 30. All right, 30, there we go. And we're going to go ahead and run the back test. Cool. So if you were to just buy the S&P 500 and dollar cost average, like most financial YouTubers talk about, you would be down about $2,000 on your money, okay? Now, if you were to just do bear call spreads every 30 days, okay, you would be in a $7,256 profit or 63% return on capital, okay? You used 11,500 throughout those this time, and you made 63%, okay? This was a strategy that I deployed. Not very hard, right? And if we go to the details, number of trades, 74, right? Largest individual loss, $900. And average profit per trade was $98, okay? So yeah, you made 63% on your money doing bear call spreads every 30 days, all right? You could have also done long puts, just buying a leap, maybe not a leap, but buying a long put 90 days out. Let's test that one. 90 days out, just buying a long put, meaning you think the market's going down, so you just buy a put. 70 delta, so it's in the money, so you're making enough money when it does go down. And then you close out at 50% of premium. So 50% profit, you close out. Let's test that one, okay? So new back test. We're gonna go select a different strategy. Long put, which is bearish. I'm gonna change that to 70 delta. We're gonna go 90 days to give ourselves enough time to be right, and we're gonna take 50% of profit, okay? Let's run the back test. If you were to just buy and hold every 90 days on SPY, you'd be down $667 or 25% on your money. You'd be down 25%. If you just bought a long put every 90 days, you'd make $3,772 or 142% return on capital. Okay, think about that. If you put 100 grand in long puts every 90 days, you'd be making double your money, more than double your money, okay? So that is that, right? That's actually the best strategy, but the risk is you're paying a premium, okay? Now there's also short puts, which is a bullish strategy, but you're doing 15 delta. So let's go ahead and jump into that. 30 days to expiration, 15 delta, collecting 50% of premium. Okay, let's go ahead and do that. So new back test. We're gonna do a short put, which is bullish, right? Cash secured puts. 30 delta, or we're gonna do 15 delta, not 30, because we wanna be further away from the stock just in case. 30 days till expiration, and we just close out at 50% of premium. Okay, now I didn't close out of these. If I got assigned, great. I just got assigned, kept the stock for the long term. But if you wanted to just collect income, you could just close out at 50% of profit. That's gonna be your best bet during a bear market. So let's run the back test. There we go. If you were to just buy and hold every 30 days, the SPY, you would have been down 23% or $13,000. With this strategy, which is bullish, okay, it's a bullish strategy, you'd make $4,000 and you make 6% return on capital, okay? 6.82%. Not bad, not the best. I mean, it makes sense because you're using a bullish strategy in a bear market, so you're not gonna make crazy returns versus doing a long put, but still better than losing money, okay? So let's talk about what I specifically did. So what I did was I just followed simple rules, okay? I said, I'm gonna sell 20 delta puts, cash secured puts, when VIX is over 25, okay? If you don't know like what the VIX is, let's go ahead and just look at that. We'll just look at the VIX, all right? Let's go to charts actually, that'll be a little easier. Let's go back here to, I don't know, 3 years, okay? And we'll go back to we'll go back to actually 5 years so you could see 2022, okay? The VIX was very elevated. Most of the time it was trading above 20 most of the time, okay? But there was points where it went a little bit below 20 and 23 was kind of like that midpoint. It was kind of that midpoint. In fact, the Bollinger Band is telling you so. 23 was kind of the midpoint, the mean average VIX price. And VIX is the fear index. So my rule was sell 20 delta puts when VIX is over 25, okay? Let's go back there. VIX was over 25 lots of the time, right? But then it would retract back. You just see it go up, then retract back, then go up, retract back, go up, retract back, right? So it's up and down market. What happened is most of the time I would just keep the premium, but sometimes I got assigned on the stock. And if I got assigned, I kept the stock. That's a long-term hold that once this bear market is over, I'm gonna make double, triple, quadruple my money on, especially on like NVIDIA and high volatility stocks like that. The next strategy, sell 30 delta bear call spreads, which we just went over in the back testing, when VIX is under 23. So when VIX is low and there's not as much fear, but we're in a bear market that doesn't make any sense, right? You start selling the bear call spreads, because that's usually when the market bounces back up. It bounces back up, right? And we could take a look at it. Let's go to SPY. All right. So yeah, there was times back here when it would go all the way down and then bounce back up. Boom, bear call spread. Go all the way down, bounce back up. Boom, bear call spread, right? And I just kept doing that. So you sell 30 delta bear call spreads when VIX is under 23, close out at 50% of premium, and just wait for the next opportunity. And then lastly, I sold covered calls when VIX was below 23. On my shares that I got assigned on, or the shares that I currently owned, okay? 15 to 30 days out, and just sold covered calls. Did I get called away? Rarely, but potentially it does happen. Cool, if it does, great. I made a little profit on the shares, profit on the call. But that's basically the strategy. It's not that hard. You definitely have to be more cognizant of your entries and exits. You have to be very particular with that. But if you understand the flow of money, there's no reason to be afraid, right? There's no reason to be afraid. Like, do I see a bear market coming anytime soon? No. The Fed is constantly, they're going to be lowering interest rates for the next couple years. So the next bear market that I foresee will probably be somewhere in 2027, maybe later. Could be earlier if the Fed announces something different, but don't worry, I'll keep you updated. So if you enjoyed this bear market tutorial, hit the thumbs up button, comment down below with any questions. I'm going to be answering all questions on this video, and I'll see you in the next one. Take care.